I want you to picture the financial markets right around late April, early May of 2026. The AI boom is just in full swing, but the narrative has violently shifted.
Oh, completely. It was like whiplash.
Yeah, exactly.
Yeah.
Because, I mean, if we look at April 24th, 2026, Intel, which the broader market had basically treated like a fossilized dinosaur for, the better part of a decade, they exploded over 23% in a single trading session.
Right, which is just a massive move for a legacy giant.
Huge. We are talking about tens of billions of dollars in market cap just materializing in hours. But meanwhile, NVIDIA, the undisputed king of the AI hill, barely moved. It just sat there stabilizing around the $208 mark.
Yeah, the contrast was incredible to watch in real time.
Welcome to the Deep Dive. Today we're looking at a leaked, highly sophisticated trading log and some strategic dialogue from an expert market observer. And they're navigating this incredibly volatile April 2026 earnings season.
And it really gives us a masterclass in how the smart money was actually playing the AI hardware space.
Right, because the mission today is to decode those strategies. The smart money has completely abandoned that initial gold rush phase. Like, everyone's obsessed with the gold, the GPUs, but suddenly they're pivoting to the infrastructure, the shovels, the land itself.
Yeah, it's not just about picking a stock and hoping it goes up anymore.
Exactly. Okay, let's unpack this, because the sources show it's about how you structure risk, how you generate income, and how you place asymmetric bets when the market is just utterly euphoric.
And to understand that options flow, we really have to look at the hardware shift that caused it.
Right, the transition from generative AI to what the sources call Agentic AI, or AI agents.
Yeah, agentic AI operating at the edge, that's the key.
So break that down for me, because wait a minute, for the last 3 years, we've been told GPUs are the undisputed kings of the future, right? Are you saying the old school CPU giants are suddenly taking the throne back?
I mean, yeah, in a way, it comes down to the fundamental difference between training a model and running an autonomous agent.
Okay, so training versus running.
Right. When you train a generative model in the cloud, you're crunching 1 trillion parameters from scratch. You're doing matrix multiplication on just a colossal scale.
It's massive amounts of data at once.
Exactly. And NVIDIA GPUs are purpose-built for that. They're basically thousands of simple arithmetic logic units on a single chip, doing massive parallel math.
Right.
But an AI agent changes the workload completely.
Because an agent isn't just generating a poem or, predicting the next word. It's autonomous software.
Yes. You give it a high-level goal, like audit last month's travel expenses and email the discrepancies to accounting.
Which requires a ton of different steps.
Precisely. It has to break that goal down. It uses external tools, opens a web browser, queries a local database. That requires high-level logical reasoning, task planning, and OS-level system scheduling.
And those aren't parallel tasks, right?
No, they're highly sequential. You can't do step C until you have the answer from step B.
Makes sense.
So if you run that heavy branched conditional logic through a GPU, the parallel architecture actually bottlenecks. But CPUs, they've spent 40 years perfecting sequential processing and deep branch prediction.
So the compute bottleneck physically shifts, like the AI brain moves from the visual cortex back to the prefrontal cortex. The sequential logic plays right into x86 and ARM CPUs.
Exactly. And there's a huge economic reality here, too. The sources note that top-tier GPUs are still incredibly scarce and offensively expensive.
Right. An enterprise can't afford to run every single localized daily workflow through a massive cloud GPU cluster.
The latency is too high, and the compute cost destroys their profit margins. So the new standard is high-performance CPUs with moderate VRAM. You run specialized models locally on the edge device.
Right on the phone in your pocket or the PC on your desk. So the compute is migrating. But if I'm looking at that 23% Intel pop on April 24th, chasing a stock that just popped that much in one day feels super dangerous.
Oh, it's a massive trap. And the trader in our logs explicitly avoids just slamming the buy button on Intel the morning after.
Yeah, because if you buy after a move like that, you're basically just exit liquidity for the institutions, right?
100%. It's amateur hour. The smart money knows the asymmetric risk doesn't live in the primary asset anymore. It flows into the second-order effects.
The hidden pick and shovel plays.
Right. If we connect this to the bigger picture, you have to ask yourself if edge CPUs are suddenly running drastically hotter and faster, handling way more complex memory loads, what else breaks?
Well, the logs highlight 3 specific hidden sectors. Let's start with memory and custom chips. Because if the CPU is running that fast, it starves if it can't pull data quickly enough.
Right. The memory bandwidth is the primary constraint.
And the sources point to Micron, ticker MU, specifically for high bandwidth memory, and Broadcom, ticker AVGO, which was trading around $422.
Broadcom is fascinating here. They are the undisputed king of custom ASICs, application-specific integrated circuits.
So if a big tech company wants a custom chip just for their specific AI agent workflow,
They have to go through Broadcom. They provide the essential networking blocks that let these custom chips talk to each other. You literally can't build a custom AI cluster without paying Broadcom.
wow, okay, so they're the toll road. But the second sector is almost purely physics, cooling and power.
Yes, the thermodynamics of AI.
The logs look at Vertiv, ticker VRT, trading around $323, and Bloom Energy. Now, the sources note Vertiv is highly volatile. The Chinese notes literally call it an airful or a demon stock.
Yeah, a demon stock because it swings so wildly. But the thesis is absolute. Air cooling in the data center is dead.
Just mathematically dead. Like, if you upgrade your car's engine to a massive V8, you can't keep using bicycle brakes. You need new cooling.
Exactly. The thermal design power of these clusters is insane. You're trying to cool a blast furnace with a desk fan if you use traditional air conditioning. Liquid cooling is now mandatory, and Vertiv owns that infrastructure.
And Bloom Energy bypasses the public power grids, which are completely overloaded, right?
Yeah, they use solid oxide fuel cells so data centers can generate their own localized power. Because the utility companies are saying they can't provide the requested power for years.
Unbelievable. And the third hidden sector is edge security, which is fascinating because if you have an AI agent on your local PC reading your emails, accessing your bank accounts, the attack surface just explodes.
Right, generative AI in the cloud is walled off, but a local agent has system-level access.
So if a hacker injects a malicious prompt locally,
The agent just hands over the data. It thinks it's doing its job. So companies like CrowdStrike or Checkpoint become essential firewalls. You need real-time auditing of the AI's behavior.
okay, so we know what assets are valuable: Broadcom, Micron, Vertiv, CrowdStrike. But valuations in late April 2026 are highly stretched. The market is euphoric.
Highly euphoric.
So if you buy Broadcom at 422, a 10% market correction wipes out a huge chunk of your capital. How does the smart money acquire these assets without chasing all-time highs?
They move to the options chain. They use a sell-put strategy.
Okay, break this down in plain English for me. What does selling a put actually mean in practice?
Selling a put is essentially acting as an insurance provider for the market.
Okay.
You get paid a cash premium up front. In exchange, you promise to buy a stock at a specified discounted price in the future.
So if the stock drops, you're forced to buy it, but at a bargain.
Exactly.
Right.
And if it doesn't drop, you just keep the cash premium.
Win-win if it's a stock you actually want to own.
Exactly. Now, the logs outline a 100K portfolio setup. The trader establishes the anchor by selling puts on SMH, the semiconductor ETF, which was trading around $506.
And they targeted the 430 to 460 strike. So that's like a 10 to 15% safety buffer.
Right. And the sources say using SMH disperses single stock earnings risk.
Okay, but wait, I have to push back on that. Because SMH is incredibly top-heavy. It's massively concentrated in NVIDIA. And isn't the whole thesis that the market is pivoting away from cloud GPUs?
It is, yeah.
So if NVIDIA takes a hit, SMH gets dragged down anyway. Aren't we just catching a falling knife on NVIDIA?
That's a great critique. Yes, SMH has heavy NVIDIA risk, but from an options pricing perspective, you're trading the math of the ETF wrapper.
How so?
The implied volatility of an ETF is mathematically lower than the average of its individual stocks. Intel might pop 23% while NVIDIA is flat. That dampens the overall volatility.
Okay, so it's about volatility compression.
Exactly. It creates a slightly lower yielding, but statistically safer foundation than selling naked puts on NVIDIA.
Got it. And then they also sell puts on the hardware titans directly, Broadcom at 360 and TSMC at 340.
Right, and this is the psychology of the trade. It's perfect for a market that is fundamentally strong but feels just too high to buy outright.
You're literally getting paid to wait for a dip.
Yeah, you sit there, you hold the premium, and every day the stock doesn't crash, the option loses value through time decay, and you profit.
Here's where it gets really interesting, though, because how do you take a great yield from selling those puts and turbocharge it without taking on insane margin debt?
You double dip.
Yeah, the double-dipping capital efficiency hack. Because normally, if I sell a put, my brokerage locks up my cash as collateral, right? It just sits there dead.
Yes, standard Regulation T margin rules trap your cash. But the sources reveal a brilliant institutional loophole.
Right. Instead of holding raw cash, the trader parks their 100K in SGOV, which is a short-term Treasury ETF.
Yes, yielding roughly 3.94% annually at that time.
Wait, is this legal? Are we getting paid twice on the exact same pile of money?
Oh, absolutely, because brokerages view short-term U.S. Treasuries as a cash equivalent. The margin haircut on SGOV is incredibly low, maybe 1 to 5%.
So they let you use SGOV as your collateral for the short puts.
Precisely. You collect the 18 to 24% annualized from the put premiums, plus the roughly 3.9% from the Treasuries.
So your total annualized yield pushes 22 to 27%. That's credit card level interest.
Yeah, it turns you from a mere stock picker into a capital arbitrager. You are arbing the spread between the risk-free government rate and the semiconductor volatility premium.
It's an amazing defensive fortress of yield, but, if a fortress only plays defense, you still need a surgical strike on offense to capture the upside.
Right. And that brings us to the primary catalyst in the logs. Qualcomm, ticker QCOM, on April 29th, 2026.
So let's set the stage here. Prior to earnings, Qualcomm is trading between 148 and 156. The market viewed it as a boring cell phone chip company.
Yeah, low-growth cellular play.
But then they drop a massive earnings beat. And, crucially, a staggering $20 billion stock buyback.
The stock just surged 13.6% after hours to 177.21.
And the trader compares it to ARM. ARM was trading at an astronomical 300-plus price-to-earnings ratio. But Qualcomm, even after the pop, was sitting at a mere 13 to 21 times forward PE.
What's fascinating here is the narrative shift. The market realized Qualcomm Snapdragon X Elite chips were about to dominate the AI PC space.
Right, going head-to-head with Apple Silicon.
Exactly. It triggered a massive valuation re-rating. They had the buyback creating a floor, and the AI PC narrative driving the upside.
But how did this smart money know Qualcomm was going to keep running, rather than just fade after the pop? The sources say they looked at the options tape.
Yes, the tape never lies.
So decode the jargon for me here.
Yeah.
What exactly is an out-of-the-money buildup and an IV right skew?
Well, let's start with IV skew, implied volatility skew. Normally, downside protection puts cost more than upside speculation calls.
Because panic is stronger than greed.
Exactly. People overpay for insurance, so usually you have a left skew. But the traders saw the exact opposite on Qualcomm, a severe right skew.
So the calls were more expensive. Like a bidding war on a house. People aren't looking at fundamental value anymore. They're just throwing cash over the asking price because they're terrified someone else will get it.
That is a perfect analogy. It's FOMO pricing. The fear of missing out on the rally becomes greater than the fear of a crash. That's a gamma squeeze environment.
And the out-of-the-money buildup.
The logs noted over 27,000 contracts piling into the $200 calls expiring way out in December 2026.
Wow, so that's not day traders.
No, 27,000 contracts expiring 8 months out is institutional block buying. It's the smart money betting on a multi-month paradigm shift.
Okay, so knowing the stock will go up is one thing, but executing the trade is where people get distrayed. The logs warn heavily about the threat of IV crush.
Oh, IV crush will wipe you out even if you're right about the direction.
Right, so if I buy a call right at the market open on April 30th, the morning after earnings, I'm buying at peak implied volatility.
Yes, you are paying top dollar for the mystery that just got solved.
Right, and as the day settles, that volatility deflates. So my option loses value even if the stock creeps up.
Exactly. Your Vega premium disintegrates faster than your Delta gains.
So the tactical execution from the sources is strict. Wait until 10:30 a.m. or 11:00 a.m. to buy.
Right.
Let the retail frenzy burn out.
Yes. And specifically, they bought the June 18th 185 strike call.
Why June 18th? Why not May?
Because of the timeline, early June is Computex, the massive Taipei computer show.
Oh, right, where Qualcomm shows off the AI PC capabilities.
Exactly. You buy the June expiration to intentionally capture the volatility leading up to that known PR catalyst.
And the trade management rule here is brilliant. If Qualcomm jumps to 190, the expert says immediately sell half the position.
Right. Lock in the principal.
Which is so hard to do psychologically. If you have a winning lottery ticket, you want to hold it. Why sell half?
Because then the rest of the trade is functionally risk-free. You let the remaining contracts ride on house money. It removes all the emotional anxiety.
Speaking of anxiety and traps, the host, well, I have to bring up the other two high flyers from the sources. Dell trading at 206 and Marvell trading at 160.
Yeah, the dangerous allure of the gamma trap.
Right, because they had massive right skew and options activity too. Why didn't the trader go all in on them?
Dell was already at historic highs. There was no valuation gap like Qualcomm had. It was purely a momentum gamma squeeze.
And once the call buying stops, the squeeze collapses.
Precisely. And Marvell was driven by rumors of custom Google ASIC chips. The options were insanely expensive due to pure speculation.
So how do you avoid those traps? The expert shares a volume rule.
Yes, the
Yeah.
ultimate rule. You never buy a high IV setup unless there is a volume breakout.
Meaning the first hour of trading shows 2 to 3 times the normal daily average volume.
Exactly. Without physical share volume confirming the institutional buying, those high IV options will just bleed you dry.
This raises an important question, though. How do we deal with the regret of missing out? Because the trader in the logs regretted missing Marvell's pop.
Sure, it's human nature to feel FOMO, but the expert explains that skipping Marvell was actually the mark of a disciplined professional trader.
Right. You concentrate capital on the highest probability setup. Qualcomm had the valuation gap and the $20 billion buyback safety net.
Exactly. Missing Marvell is just the cost of doing business properly to survive long term.
So what does this all mean? If we summarize the playbook, you use solid tech giants for long-term growth. You use SMH, Broadcom, and TSMC put selling, combined with SGOV treasury yields, for a 20+% cash flow engine. And then you use a tiny fraction of that cash flow to take asymmetric, data-backed bets on valuation gaps like Qualcomm.
It's a beautifully balanced system.
It really is.
Oh.
But I want to leave you with a final thought to mull over. As agentic AI models become advanced enough to read these exact open interest and 5e skew signals in milliseconds, will these market inefficiencies disappear entirely?
That is the big question.
Right. If an AI agent is managing everyone's portfolio in 2030, instantly acting on the tape, who is left to take the other side of the trade?
It could fundamentally change how price discovery works forever.
Exactly. Thank you for joining us on this deep dive. Keep questioning the narrative, and we'll catch you next time.